Hello, everybody. Thanks to everyone who's joined us today. We're going to give those who are still trying to log in another minute or two before we start. There may be some polls that do come up on your screen, though, so do feel free to answer some of those that can really help us out. So welcome. For those of you just coming in, we are waiting to get set up here. So just hold on for a moment and we'll start here in another minute or two as the last ones come in. Thanks. Welcome. Well, welcome everyone. This is Jake, a Navy veteran, and I am the CEO of Localvest. I want to thank you for joining us for today's event, Launch with Localvest. Localvest is a marketplace where investors and veteran entrepreneurs connect to build America's fastest growing companies. We're veterans and founders ourselves, and we are on a mission to build the largest community of veterans investing and supporting veteran entrepreneurs. And we do that because we believe that the sense of duty and grit and determination that we had serving our country carries over into the business world. Every company that you see on the platform is led by one or more veterans or military spouses. And we make connections by hosting events like this one, and we share the opportunities with the thousands of our ever-growing network. And we also help to market on digital platforms too, which expands the reach to even more investors. And then in the background, we have tools that can help you track and engage with potential investors efficiently. So I have a few calls to action for you all. If you are an investor, I encourage you to sign up for the platform. It's free, and you'll see even more active deals and be the first to hear about new ones as they come in. If you are currently raising capital or thinking about raising capital for your own venture, reach out to us and discuss how we can help you get more leads from people who understand you, and maybe even make that first step into digital marketing if you haven't done it before. And if you want to help in our mission to connect investors and veteran-led companies in some way, reach out and we can see how we can work together. Today, we have 3 companies who are going to share their opportunities, and each of them is going to be making a pitch presentation to you. And I'm going to come back after each of those and ask a few questions of them. Now, this is a Zoom webinar, which means that you can see us, but we cannot see or hear you, but the chat is live. So if you have a question, I encourage you to ask it in the little Q&A block that you see, right? We cannot interact with the chat on the panelist side, but we can answer questions in the Q&A section, so put it there. But don't worry, if we don't answer your question there during the session, they are saved and we'll pass those on to the companies and we'll answer those offline. You'll also see some of us can interact with the chat, and we'll put some helpful information to you about the companies along the way. You'll also see a few more polls like we had earlier, and you'll have a chance to say if you want to set up a conversation with one of the presenters. I'll tell you, if you're not sure about something, you see something that it piques your interest in one of these companies, I encourage you, set up time with them. It's a great opportunity to talk to a fellow veteran, or if you're just speaking to someone from the company, and have them answer the questions for you and do a one-on-one conversation. It's totally worth it, and you'll find out more about the opportunity if it's something you're interested in. And lastly, everyone who signs up is going to get a recording, so you do not have to furiously take notes. You can go back. You'll get every link for connecting with the companies when you get that email. So with that, we have the 3 incredible companies with us today, and I can't wait to hear some of the great things they're working on. So without further ado, let's get things started. And our first company today is Warrior Centric Health. And the founder, Ron, is with us here today. Ron graduated from West Point and he served as an officer in the Army. And he is credentialed as a certified medical representative and also a board certified diplomat by the American Board of Disability Analysts. He's also an adjunct instructor in the Department of Family Medicine and Community Health at Rutgers Robert Woods Johnson Medical School. But he comes to us today as the CEO and co-founder of Warrior Centric Health. In fact, this is the second time that Warrior Centric Health has been here. You were here before and raised capital in an earlier stage. And after the success of being able to raise with the veterans, he wants to have more veterans come and hear about Warrior Centric Health. So Ron, I will turn it over to you to tell us about the opportunity for us to be able to invest in Warrior Centric Health.
Well, Jake, thank you very much. It's a pleasure to be back with the Localvest family. And again, wanted to share with you all what we've done since our last investment. And I think you'll be very proud of the progress that that we've made so far. So let me just make sure I've got everything going. Next slide, please. So at Warrior Centric Health, we've created the nation's first health equity population health platform, addressing what we consider to be as a major pressing issue for the nation. Next slide. And so America, we do have a big problem. And when we look at specifically at this problem, it is how do we address, next slide, the fact that unique is a uniquely vulnerable population. Specifically, if you look at the military, most people don't realize we're exempt from OSHA requirements during training and deployment. If we were any other corporation in America, they shut us down tomorrow. And so this has a significant impact on our health, and Warrior Centric Health is looking to, one, bring this to the nation's attention, and number two, provide the capacity for healthcare systems to improve the care delivered to us. Next slide, please. So one of the things that I think is a critical inflection point for the company is the fact that when we look at the Joint Commission, which accredits hospitals, and if hospitals aren't accredited, they cannot get paid their money by Centers for Medicaid and Medicare. So this is a major, major inflection point. They are required now to actually have a written plan on how they're going to address healthcare equity. And Warrior Centric Health have, we believe, the nation's first platform ready to go to market to address this requirement. And we're very pleased to be partnered with KPMG to deliver our platform at scale across the marketplace. Next slide, please. So what I'd like to do is just take a few moments to actually share with you what the platform looks like in this commercial setting, and we do have it in the DoD. Could you please play?
You work hard to provide the best care for all your patients. But for vulnerable populations like the warrior community, best care may mean different care. Warrior-centric health transforms population health management for veterans, service members, and their families. As an authorized warrior-centric health facility, you'll have everything you need to deliver great care to the warrior community through Warrior Hub, your own easy-to-use digital portal. Warrior Mark integrates data from multiple sources to help you assess, benchmark, and track the population's health. Once you know who your warrior population is, your staff learns how to fill in specific clinical gaps in these patients' care. The warrior-centric health education and training solution provides fully CME CE accredited education, so you can optimize treatment in the exam room and support it outside too. WarriorCom provides you with an ongoing feed of customizable content, as well as insights on how to connect with the warrior community effectively. Warrior-centric health provides all the tools to optimize care to those who need it most. Our nation's warriors. It's how warrior-centric health makes hospitals heroes.
Thank you very much. Key thing about that platform that I want to leave you with is that requirement that now is a mandate. We have the only solution in the marketplace ready to go right now. Everything that you saw in that video is what hospitals are required to do. The only question is that they have to pick a patient. They don't tell them what patient group to pick, and they have to pick a disease state. That's where Warrior Centric Health is going to the market. Say, if you're going to pick any vulnerable population, darn it, you better pick the military and veteran community. Next slide, please. So with that said, when we look at Yeah, I think we need to go forward. Yes. All right, great. So we represent 25% of the US population when you look at our families and active duty, National Guard, Reserve, and veterans. So it's a huge marketplace. Next slide, please. And when we look at the health conditions that we are disproportionately impacted by compared to the general population, we skew way above the general population. And again, it goes back to that toxic work environment that we have served in on behalf of our nation. Next slide, please. Now, the challenge we have is that most people think that the VA is caring for us. They're not. Of the 19 or so million veterans, only 9 million are registered with the VA for healthcare services. Only 6 million get their care at the VA on an annual basis. And only 12% of male veterans get their care at the VA only. And only 20% of female veterans get their care at the VA only. So we, along with our families, are in the commercial sector, and no one ever built a platform to address that. Next slide, please. And that becomes an issue because the RAND Corporation did a study and found that only 2.3% of providers met all the criteria to provide care that was timely and culturally competent for healthcare for the military and veteran community. So therefore, hospitals are operating inefficiently, as well as increasing costs and lost revenue. Next slide. We have a very dynamic team that if anyone's interested, we'd love to get a chance to meet you. Next slide. Next slide. And so we are the only solution, again, to meet this moment. Next slide. Again, it now sits in the SaaS platform and the commercial marketplace of Microsoft. Microsoft salespeople actually get a commission off of selling our platform, and we're a preferred solution. So we are a software as a solution, and we're one of the top 22 companies in Microsoft's portfolio of healthcare companies globally and their Microsoft for Startups program. Next slide, please. Again, so the solution, again, is health systems becoming an authorized warrior-centric health facility. Next slide. It allows them to be able to see us, serve us, know us, and acquire us as very valuable patients. Next slide, please. So all they need are the tools. Next slide, please. And again, so it looks like, have you served, identifying us, saying, hey, look, we understand you may have been exposed to burn pits. We've taken some coursework relative to that. Let's get a pulmonary function test on you to baseline you. Next slide, please. Hospitals, again, it's opportunity for increased revenue because we're a highly insured patient population. Number two, we're able to help them decrease costs, and they're able to meet a mandate. Next slide, please. So what are they buying? All the knowledge, all the expertise, all the process, content, technology, all proprietary. Next slide, please. We got significant traction in the marketplace with significant entities such as Kaiser Permanente, Trinity Health. We're a cyber technology company with the Department of Defense, so we have 20-year data rights. We have no size limit, so the government literally can write us an $80 to $100 million check contract tomorrow, no questions asked, and it's non-protestable. The state of Maryland is our lead investor in our Series A round, along with Stone & Nelson Group. Next slide. Our model is a subscription-based model for health systems and hospitals based on their size. Next slide, please. And of course, we have a hockey stick, but again, you can have a hockey stick when you have a regulatory requirement, and we plan to execute against it. Next slide. Thank you.
All right, great, Ron. If you don't mind, I have questions to go through. When we had talked before, there were some talks about different strategic partners that you're working with, and some may come out later, go through, but what is it that, why are some of these strategic partners coming to you now? What makes Warrior Centric stand out?
Yeah, so if you,
a strategic partnership.
So a few things. Microsoft, a lot of people don't realize with things being digitized, it's a $4 trillion marketplace. One of the big areas that tech are going into a healthcare. And so specifically, Microsoft's one of the things they're leading into is population health and health equity. And so we are now Microsoft's lead health equity and population health platform. And so they put a lot of resources behind us over the past 2 years in the program, and now helping us go to market. And that's why I said not only we're a SaaS solution, a software as a service in the Microsoft portfolio. Again, they now see us being the tip of the spear as they're looking to execute as a technology platform in the marketplace. Our IP, their technology is a win-win. KPMG, much like the other big four, when you look at Deloitte, Ernst & Young, PwC, they all have health equity divisions now. Why? Because we learned from COVID, okay, that as the country becomes more diverse, if we're not addressing some of these health disparity issues, and again, I would put veterans as a vulnerable population, it's a Mack truck about to hit us as GDP becomes more and more percentage of healthcare. So all of them have established practices. It just happens to be with KPMG, they now have the first marketable digital SaaS solution in the marketplace with Warrior Centric Health, and the emphasis on the military and veteran community. We should be at the front of the line as it relates to addressing health equity, health disparities because of our service. And that's what we're projecting into the market. And part of our Series A round allows us to execute against that plan.
And what were you saying? So the mandate, can you say more like what exactly the mandate is that moves it from this is a nice to have to you're saying now they need warrior-centric health in your position? Well,
yeah. So when we have a requirement for the Joint Commission, they literally can shut a hospital or department down if they're not meeting certain parameters of best practice standards. So now the Joint Commission has made now health equity a national patient safety goal. It's online with infection control in a hospital. You cannot duck and hide this one. You must pick a population. You must pick a disparity. And what we're saying now, since we have the solution, we have the platform ready to go, we have the technology, we have the partners, and we're DoD cyber technology, we are projecting into the market that the population you should at least pick, if not first, is the military and veteran community. And we are going to be unashamed about that in the marketplace. They have to do it.
so why, want us to go through, why would a healthcare system, we talk about, constantly they're trying to cut out costs. Like why should they pay for the platform instead of trying to do something on their own then?
So one of the things is that the military and veteran community is an untapped marketplace. We have 92% of us have insurance compared to 86% of the general population. We have high chronicity and acute conditions where hospitals make their money. So number one, they should do the right thing by taking care of us. But the bottom line is we're a more valuable patient money-wise than almost any other marketplace. So it's a competitive advantage. And like I liken this to USAA. Warrior-centric Health empowers hospitals and health systems to be the USAA powered by our platform nationally. So if you want the brand connectivity that USAA has from a financial services, the marketplace and the technology are in place for hospitals and health systems to create that brand connectivity. And they do that through our platform. So it is a money-making opportunity. Oh, and by the way, you can comply by regulations. Oh, and by the way, you could do the right damn thing.
I like it. So Ron, I think we're approaching our time here today, but Ron and I have had a lot of discussions in person and several phone calls to go through. There is a lot to this. I mean, this is, those of you who may have heard this a couple of years ago, there's a lot of advancement done, a lot on the regulation side. It's worth reaching out to Ron and have a conversation about what's happening and what this all means, because I know, Ron, you could talk for ages when it comes to do it. And I encourage all you to reach out to find out more about this and about what's going on, because it's a very exciting thing and an exciting opportunity to be able to come in. So I encourage you to reach out, and you'll have a link to be able to do so. And there's contact information we'll put in there, and you all get the link. So Ron, thank you very much for speaking to us today. All right, there's another poll up there too. Make sure we can quick connecting to go through that, but also you'll get the link. I encourage you to reach out to Ron when you get the chance. All right, we're going to go into our next presentation here as well. You say for something completely different, which is we have Alex from Open Atlas with us today. Alex is a Marine, and towards the end of his service, he started to read every book he could find about real estate investing, and he started to go into the short-term rental space. He's developed several different projects along the way, managed a lot. He's got a YouTube channel, it's pretty exciting, called Alex Builds. And now he's the principal and CEO of Open Atlas. And if you look around online, you will find things with Alex's name on it, teaching about short-term rentals. He started from building his first short-term rental property and scaled up his investment firm by developing investment in lots of unique properties. But I don't think you've seen anything like the one that Alex has for us today. So I will let you take the show here, Alex, and look forward to hear what you have to say.
Hey, thanks, Jake. Yeah, I'm super excited to be here. So this property that we've been negotiating this property for since February of this year, and this property is, in my opinion, the top hospitality property investment opportunity in the country. So a little bit of overview highlights of this property. We got this property off market. So it's a rare off market luxury micro resort opportunity in Asheville, North Carolina. There are 20 unique units with a wedding pavilion. The biggest thing about this property, this whole deal itself, is that the owners of this property allowed us to do, and it took a couple months of convincing them, but we have an owner financing deal on this property at a 3% interest rate for 5 years, amortized over 30 years, which is nuts. I mean, even when we were at historically low interest rates, you couldn't get 3% at a 30-year AM. Another huge thing about this, which we'll talk about a little bit later, is this property has indefinite conditional use zoning that runs with the land, meaning that no matter what happens in vacation rental world, in the short-term rental world, in whatever economy, in wherever we are, the city, the county cannot take away this permit, this license, which took the owners about 2 years to get. The property is 12 acres and it sits practically in a 360 mountain view area, like on a hillside community. So here's the highlight. So it's a $20 million acquisition. The owners are owner financing 12 million of it. Again, indefinite conditional use zoning, and then we have 93% year-round occupancy, which is huge. That is throughout COVID, throughout the lockdowns. They were only closed down for 2 months, but they've had a 93% year-round occupancy. This market, Asheville, North Carolina, which is where I live as well, tends to be a little bit less seasonal. We have a 10.35% cap rate just in year one, which is absolutely insane. We've got half a mile worth of hiking trails throughout the entire property. And then once everything is fully built out on this property is going to be able to sleep up to 83 people total. So here are the current properties. So the current properties, there's 7 of them. We have the first property, which is Perch. Then we have Sanctuary, which is the original property, Alchemy, Wizards Hollow, Farmhouse, Dragon's Knoll, and Airy. This is a treehouse community. So it's a combination of a treehouse community. And when I say treehouse community, it's not just like kids' tree houses. These are houses in trees, or the houses in the sky. They have full bathrooms, they have full kitchens, they have all the creature comforts, they have internet. These properties actually have city sewer, city water, and city sewer, which is pretty nuts with how high up they are. But yeah, these are the current 7 properties. And then the next properties that are currently being built out right now. These are the properties that are currently under construction. We have a castle, we have Phoenix, which is a spaceship. We have 2 A-frames there. We have something called a Prism, which is a property that has a whole bunch of windows on it. Another property called Steampunk, and then the last one there is Crater. We also have a 6 unit cottage community with a wedding pavilion. These properties are currently being framed in right now, and I'll talk about the structure at the end on how that's working with the loan, because we are closing on this property without all the units being fully built out. So some history about the property. The current owners have lived in the mountain community. They developed the whole mountain community up there for the last 35 years. They built the current 7, and then they're finishing up. They're going to be building out the rest of them as we're taking over the property. This property lives in an HOA, which is very unique for short-term rentals, because usually I've coached thousands of students in short-term rentals, and I usually advise students to not invest in properties that are in HOAs. But this property is baked into the HOA. It's in a gated community surrounded by multi-million-dollar houses, which is very, very unique for vacation rentals in general. So our plan moving forward, so you might be thinking, okay, 93% occupancy, what more can you do? The biggest thing that we're going to be doing to increase our average daily rate is social media. So I have experience with promoting all of our other properties through social media and influencer channels. And this current property has 45,000 followers on social media, on Instagram specifically. This property also has tens of millions of views on TikTok, YouTube, Instagram, and LinkedIn. And our goal is to take the property from 45,000 followers all the way up to 1 million. That will allow us to increase our average daily rate. And then it will also allow us to not depend too heavily on channels like Airbnb, VRBO, Booking.com, and Expedia, where we can essentially book up the entire calendar just by a couple posts, or by just continually posting on Instagram and the other social media channels. The other thing we are doing, though, on top of that, is the current owners are only listed on Airbnb and sort of a weird direct booking site. Once we take over, we're completely redoing the direct booking site, and then we're listing on Expedia and Booking.com. So the wedding venue potential, I want to talk about this for a couple minutes. So the wedding venue potential, we already have a wedding venue I would consider mid-tier in this market. And we recently, in the last 12 months, completely learned this business model. And we have a phenomenal wedding venue marketing company that we work with that generates all of our leads for us. They've generated 400 bride and wedding leads just in the last 2.5 months for our other property. This one is a little bit more high-end. And the wedding venue potential on this property is easily 7 figures just off the cottage and the pavilion itself. Not to mention if someone were to come in and book out the entire property of like the entire 20 units. So the property lives in Asheville. That's also where I live and where all my properties are at. So Asheville saw 12 million annual visitors last year, which is nuts. If you compare that to the Smoky Mountains, which is the busiest national park in our country, the Smoky Mountains is split over 2 states, and they saw 21 million visitors. We saw 12 million annual visitors just in our small city, and those visitors spend 813 million just in lodging alone. We also have one of the fastest growing airports in the country. That's not written anywhere there, but projections and cash flow. You guys can look at this also on the Localvest deal page. This is just a very high overview of the deal. So the potential rental income is 3.2 million roughly, and then our cash flow after debt service and everything is 1.5 million. Our closing costs and expenses there, we don't really have too many closing costs just because we're not working with a bank. Also, we're not working with a bank, and this property, the loan is non-recourse as well, which is unheard of in the banking economy that we're in right now. Year 1 through 10 projections are there. Again, this is also in the deal page if you guys want a more detailed version of this. The craziest thing to look at here is the debt service coverage ratio is 3.61 with the current loan that we have with the owners, which is insane. Investment highlights, we have a 100K minimum, $100,000 minimum investment, 506C, and then we have a 50-50 between the equity, between the general partners and the limited partners, so 50-50 split, and then we're offering an 8% preferred return. So 8% preferred return, 50-50 split between the general partners and the limited partners. This is a long-term hold. We don't plan on selling this property anytime soon. Our goal is 10 years, but I just put 7 to 10 years there because we don't know what's going to be happening in 7 to 10 years. Again, I'm going to fly through these real quick, just the team. So here's me. We have Mike Iannetta, who's the social media guy who handles all of my social media for the properties. He's going to be integral to this property. Jarek is our wedding venue marketing person that handles all of our social media and all of our wedding venue marketing direct ads to brides. Oop, I just jumped away. Sorry about that, guys. There we go. Thank you, thank you. Just one more. Yeah, next slide. And then we have Greg Dickerson, who's been on my board for the last 3 years. He has coached some of the top real estate professionals in this country, both in development and in hospitality. Next slide. And then we have Strategic Advisory Board, led by Jason Miller, which has been a very huge help with putting together this deal. Next slide. So if you guys want to contact me, there's my personal number right there. Text is preferred. Our website is not live yet for this property. You guys can just use the deal page that is on the Localvest website. That is essentially the website for this entire deal anyways, and then my email is there as well. One thing I did want to talk about real quick is with us taking over this property before the properties are fully built, that's the owners have agreed to suspend mortgage payments on this property until everything is fully built. So everything's going to be fully built latest of June of next year, but we have on top of the 3% owner financing deal that we have no mortgage payments when we close in this in October until June of next year. So we'll be able to pay out distributions to our investors after Q1. Yep.
All right. Well, thanks, Alex. And I was just about to answer that because you didn't talk about the go through. Can you say some more on the owner financing, how that came to be about? Because it honestly seems almost too good to be true, and just how that kind of that what's in the minds of the owners as they transition.
Yeah, the where that conversation came from was actually our real estate agent that put the entire deal together. We were sitting down with them. I'm very close with the owners. I've been over their house to negotiate this deal probably 30 or 40 times at this point. And that came from one of those conversations where I had come in, I believe, at like 15 or 16 million is what I offered them. And my agent had asked, well, the owners had asked if it was last year's interest rates or 18 months ago, would they wanted 20 million. And they had asked if it was last year's interest rates, would they have been able to get 20 million? And my agent said, probably. So I was like, well, give me last year's interest rate and do an owner financing deal with us. And I mean, it did take a couple months of negotiating with them. It's helping them from a tax perspective as well. But they were able to get their 20 million number while at the same time negotiating an owner financing deal. And then on top of that, they wanted to be they want to step away from the operations because they handle all the day-to-day stuff. And the conversation was there about waiting until June of next year, but so much stuff can happen between now and June that I just wanted to close as soon as possible on this property.
Understood. So, we hear about the things, or at least are starting to hear about, to go through like the overall, like a macro market about the short-term rental things, and if there's risk there, and is it in decline? What makes this property different or standing out that kind of bucks that trend?
Yeah, I had made a prediction about 3 years ago with one of our properties when I was doing a big raise a couple of years ago. And that was that unique properties were going to dominate going forward. Is people are looking for a more unique experience outside of just the city that they're visiting. So these properties check that box. On top of that, these aren't just vacation rentals. I consider these more of a micro resort community. It falls under hospitality compared to just vacation rentals, short-term rentals. People just say Airbnbs. When you're stepping into resort territory, a hospitality hotel, it opens you up to an insane amount of distribution channels that a normal single-family house can't take advantage of. Things like Expedia.com, Booking.com, mainly Expedia.com, and Expedia.com has 10, 20 different other channels. Marriott Bonvoy, which is a brand new channel that only is open to exclusive properties like this. So the numbers speak for themselves. I have the year-to-date numbers for the owners. They're still at a 95% plus occupancy right now. In my opinion, things have gone down with average daily rates and everything for vacation rentals. But the current owners just did a rate increase on these properties last week, and they're still booking up.
Very interesting. I know we're getting close on our time here to go through, and some of you may have more questions. But I got to take the videos that Alex has done for this. Those things are amazing. So I mean, we had conversations during one of our prep sessions about which property that we like the most. So you can see all of the insides. Like the one of them that looks like a tent is actually not a tent. There's a lot to it, and there's all these neat fly-throughs.
They're all themed in their own ways. I can't say which ones because I'll get sued. But like they're all themed in their own certain ways based off of like different movies and different fantasy shows and stuff. Yeah.
It really is something we're seeing. And if some of you are in the spot where you're like, oh, the opportunity to stay in some of these places, and actually an opportunity to invest in some of these, and they don't come up very often. So I appreciate the opportunity you came in here, Alex, and talked about them, and we'll put the contact information, but do go and check, and we'll send some of those links for the videos and the stuff on social media. It's really impressive to see. All right. So we get the question come up. Absolutely. Thanks for coming in here. All right. Our final set of presenters, give me a second as I come in on mine, is Mag Capital. So we have Neil and Drew Walgren back with us today. Neil is a partner at Mag Capital, and he has 2 decades of leadership in operations and capital markets. Before he joined Mag Capital, he was the Bay Area real estate investment firm doing acquisitions of about $500 million of income producing commercial real estate. He's a graduate of the Air Force Academy. He's a C-130 pilot. in both the Air Force and the Navy with 2,500 flight hours and combat hours in Iraq and Afghanistan. Finished off as a lieutenant commander when he left. And he also has with him Mag Capital's vice president for capital markets, which is Drew Walgren, and he's primarily here to manage new and existing equity and lending relationships. And he joined Mag Capital in 2019 after 8 years as a risk analyst and program manager at Liberty Mutual Insurance. And he's built systems to pair real estate properties with well-suited financial instruments. And he's boosted the equity relationships in order to quickly access capital for time-sensitive acquisitions like they're able to make. But they're going to talk today about the Mag Capital Investment Fund, and I'll let them talk more about the project. So I'll turn it over to you, Neil.
Great. Thanks, Jake. Hi, everyone. Neil Walgren with Mag Capital Partners. I'm a partner here with Dax Mitchell and Andrew G. And then also with Vice President Drew Walgren will be joining me today on the call. Background from the veteran side, as you mentioned, both Air Force and Navy aviation experience, Air Force Academy grad, Texas A&M business degree, and then ultimately have been in the commercial real estate capital market space for about 10 years here now. Let's see if we can go the right direction. There we go. So today we'll be talking about our second industrial commercial real estate fund. This second fund we launched back in March. This fund is about halfway full, and we'll be giving kind of an overview on the strategy thesis behind the fund and give updates on where we are in terms of capital raise, in terms of deployment into different properties so far, and really give kind of an overall state of the markets for both the industrial space and also the debt markets that we're seeing in the commercial real estate area. So this second fund we launched in March, and we are raising $60 million to deploy with leverage into about $180 million of industrial single tenant net leased real estate. The company is led by myself and my two partners. My two partners are core real estate folks. Dax and Andrew have almost 50 years combined experience in development, commercial real estate brokerage, and appraisal. We here at MAG are fully vertically integrated. As you can see on the bottom here, we do full asset management, capital markets, construction facility management, along with a risk analysis and full financial functions all in-house. Here's a snapshot of where we are as a company. So you can see really our core focus is going to be buying relatively Midwest focused industrial real estate. So you can see our kind of average property is going to have American manufacturing tenants. Sometimes these tenants will have leases either on a single property or small portfolio properties that we will purchase with capital that we're raising in the fund. And then that fund will effectively have a diversified portfolio of fully leased industrial properties. To date, we have a little over 700 million currently under management, and we've transacted on almost $1 billion of primarily industrial real estate. And the last piece I'll show before I get off this slide is our full cycle track record. It's just shy of 20% per year net returns to our investors, and that's across about 44 deals we've gone full cycle on. So really, before we jump into the before we jump into the fund here, really I like to look at kind of the top level. What is the reason why are we buying this right now? And ultimately, from a very high level, what we've seen over the last 12 months is interest rates have risen, and in combination with that, I'll show you a nice graph here in a minute. The cap rates that we're able to acquire these properties have raised and grown in a corresponding fashion. So what does that mean? Effectively, for the same purchase price, we're getting better income, better rents off of those same acquisitions, or put another way, for a set amount of income, we're paying less now, a lower basis on that real estate. So what we feel is, from our perspective, from a buy side, we're seeing some of the best opportunities in the industrial space right now to acquire that we've seen in the last 10 years. Really, this is utilizing a huge amount of experience from both our team and specifically in the industrial space that we've demonstrated really largely through individual deals for a very long amount of time, and then switched over to the fund model last year. So the first fund we fully stabilized back in December, and then rolled right into the second fund here. And really, the funds are the same verifiable strategy that we had on the individual projects, just really a diversified portfolio of about 10 to 15 different properties with independent manufacturing tenants, independent markets, and independent industries that those tenants are in. So really a nice diversified spectrum across that. And then lastly, we'll talk a little bit more about this, but our competitive, what we call a niche within that industrial niche, is going to be how we acquire. And that's largely going to be through sale leaseback. So effectively, we are purchasing these industrial properties from manufacturing companies that own their own real estate. We purchase the property, turn around, lease it back to them on 20-year net leases. And we're very good at that very niche acquisition strategy there. At this point, I'm going to pass over to Drew. Drew, if you want to talk a little bit about the kind of market, what we're seeing here with cap rates, and then we'll go into the next slides there.
Yeah, thanks, Neil. This is Drew Walgren, VP Capital Markets here at Mag Capital Partners. Really just kind of dovetailing off of what Neil just said. Why are we buying now? And, isn't, for a lot of folks are saying, isn't real estate a bad investment now? And really, it depends, right? What you're looking at. And we're still seeing opportunities to lock in cash flow from day one. So what we're showing here in this visualization is that orange line graph on the top being cap rates, where we're acquiring these properties at in that cap rate at acquisition, and that lower line being interest rates, right? And that spread in between basically shows, hey, we are able to essentially for every dollar we're borrowing at a cost of borrowing from a bank, we're able to generate more cash flow than the cost of borrowing. So positive leverage, as they might say. So over time, you've seen interest rates go up, and this graph goes back about 13 months. You've seen interest rates rise. And each one of these dots on the graph is where we locked in interest rates on each one of these acquisitions. So you'll see a corresponding cap rate above that to show we're still seeing an overall trend of increasing interest rates, but seeing the trend increase in cap rates. So pricing continuing to soften so that we're still able to lock in usually about 200 basis points, about 2 percentage points different there. And continue to see that opportunity going forward. So able to lock in these pricing and interest rates so that we can ensure we have very high degree of certainty around cash flow. I'll just roll right into this slide. This is really just visualizing the course of the fund and the term, right? We're targeting a 6-year hold period, and we're about halfway through this first period, this acquisition period. Again, we're targeting 0 to 12 months. By the end of the year, we're projecting we'll be fully stabilized and have deployed all equity into industrial real estate. So as of now, again, as Neil said, we're about the halfway point. So now's a great time in any fund to really take a look at the opportunity, because you have a little bit more certainty around what you're investing in, and you can see certainty around cash flow. We've already made distributions for Q1 and Q2, 10 and 8.4% annualized cash on cash respectively on each of those quarters. So we'll continue to distribute cash flow on a quarterly basis. But really what we want to show is this fund will diversify that risk across about 15 to 20 of these single tenant net lease properties, which really gives us a lot of safety should we run into any issues at any of them. But over 80 plus tenants that we've managed in our operating history, we've only had one default because of all the due diligence we do on the front end and really ensuring that we're buying real estate that's at a defensible basis behind that.
Yep. And one thing I might add there, if you see on the top right, you'll see a debt principal reduction and depreciation. The type of debt that we're putting on each property upon acquisition of these warehouses, we're putting 7 to 10 year fixed rate debt. So a lot of the uncertainty of what's happening in the debt markets over the next 6 to 18 months really doesn't affect us. Once we lock in the acquisition, we know exactly what our debt service obligation is. We know what the cash flow coming in, and based on that net lease structure, our tenants are paying 100% of the expenses around that real estate. So ultimately, we take in the rent, we pay the mortgage, and the rest is very predictable cash flow there. And Drew, you want to jump into the sale leaseback here?
Sure. Yeah, Neil mentioned this is the niche acquisition strategy we have, very specific, and we do it really well. We've had a lot of experience here. And really what we're doing is providing a financing instrument for a seller, an owner-occupied property, a manufacturing facility typically will have an ownership group that will own the property and say, we're looking to access equity tied up in this real estate. They will simultaneously sell us the real estate and lease it back on a 20-year absolute triple net term. So for them, again, an alternate form of financing, and they're not putting leverage on their balance sheet. So it's attractive to CFOs at some of these corporations where they can access capital, and they're using this to grow the company or using it to strengthen their balance sheet. So on the back end of this transaction, you have a healthier tenant, right? They have that much more liquidity in hand. But for us, we're in a great position because we're able to craft this new lease, institutional grade lease with annual rent increases, with quarterly financial reporting where we can continue to monitor their performance, and really having a lot of term on the front end of a very long lease. So we can hold for 5 to 6 years. And when we sell, we still have an asset with 15 or so years left of term to a buyer who's really going to be attracted to predictable yield, right? Predictable cash flow with an institutional grade lease. So this is a great transaction, and it gives us a lot of certainty on the front end and a lot of strength. So we don't have to worry about, what happens at the end of, say, a 5-year lease term. We have much more term than that.
Well, thanks, Drew. A little bit of our deal sourcing. So from my two partners on the buy sell side, really we're funneling down about 4,000 investment opportunities in the industrial space, culling that down to about 20 to 30 deals that we finally close on. Nearly everything is off market or an early look that we get through broker relationships. And that's going to be, like I said, really a niche, ultra small kind of subcategory of industrial properties trading in that sale leaseback space. Typically, they come from private equity backed transactions, or sometimes directly from those private equity backers who, as they buy a new manufacturing firm, will give us a call direct and say, hey, this firm we're buying has real estate. Let's do a sale leaseback. Drew, you want to talk the credit here?
Sure. Yeah. Overall, I'd say the broadest way of mitigating risk is really analyzing the tenant's credit. So we've really built our team around that function. We have 5 credit analysts on our team. 2 of these guys have come from institutional groups with 8 to 10 plus years of experience analyzing credit of businesses, manufacturing companies, food producers, and really understanding their history and the industry that they're in, much like a private equity group would. Where is the risk coming from? We'd like to see low leverage. We like to see consistent profitability and a long tenure of performance. But behind that, we're looking at how much profit and utilization is coming from this individual property, right? If you have a company with multiple locations, I want to know that we're investing in the property that's key, that's producing a vast majority of the profits that the company is able to get versus, sort of a utilitarian warehouse that they use for additional storage. I want a property that's going to be, they're not going to be able to exist without. And behind all that, as far as risk mitigation goes, is the actual asset we're buying. Buying at a defensible basis ensures that if we do run into any kind of trouble with the tenants, we have a very low basis on not only price per square foot versus the market and replacement costs, but also that our lease rates are well below market, and we can continue to attract new tenants if we ever need to in the future. So behind all 3 of these layers, you have diversification in the fund, which really helps mitigate the risk to a massive degree in case there was trouble at a single property, continuing to service debt as well as distributions to investors.
Cool. Thanks, Drew. So quick highlight, and we'll jump into questions here. So total equity, we're raising 60 mil. We're about halfway there, about 28 million to date as of a few days ago. 6-year hold here. Excuse me. 6-year hold here, and then ultimately have that depreciation pass through. So really, the income pulling in here will be reported through the IRS Form K-1s, seeing a huge amount of upfront depreciation flow through in the form of net losses in a good way to LPs there. Heavy co-invest from the partners, a minimum of 5% across all properties. And we talked about the debt there. One big thing I'd like to mention is this fund is currently cash flowing at a very high level. So last quarter, Q2, we just distributed out 8.4% cash on cash. So really, this is not a, hey, we're investing thinking we can raise, add a lot of value and get it to a point where it's cash flowing. It's cash flowing from day one. They're in place tenants. And really, this is going to be, what we call a light value add or a core plus investment that really is stable. It's got predictable leases and ultimately designed to weather a number of different financial and economic conditions over the next 5 to 6 years. At this point, we'll open up for questions. And actually, lastly, Drew, if you can give a quick snapshot of here where we're at from a property standpoint, and then we'll go from there.
Yeah, I won't go through each one individually, but as you can see, we've acquired a handful of acquisitions: Angie's, KBK, Colbert Packaging, K-Drex, and Strand. Some of those are multiple properties. So as of today, I think we're at 9 properties, and we have a few more deals in the pipeline. We're getting at great cap rates. We haven't seen this acquisition environment in a decade or so. I mean, some of these acquisitions are coming in. Beauty Quest Group, as you can see at the bottom, 9% cap rate. So really some of a basis that we haven't seen in a long time that really helps us protect us, but also offers a lot of upside in the future. So you can see there's still a lot of activity, and we're getting an opportunity here to acquire these properties at a very low basis.
Okay, at this point, we'll open up for questions.
Oh, all right, great. Everyone on, when we look around, there's a lot of light industrial and warehouses that are being built, a lot of them on spec. How does that macro event play into the MAG Capital strategy?
Drew, you want to take that?
I'll take it. Yeah, it's really certainly doesn't affect us day to day in our investments, because we're typically doing sale leasebacks with established tenants who usually have been operating at some location, but typically even the location we're buying for decades, right? So, and they're signing a 20-year lease. So how inventory changes from one year to the next really doesn't affect us in our performance of the investment. However, we have these really great macro trends, tailwinds in the industrial real estate industry, right? And the two main ones are really e-commerce has continued to bolster demand for industrial real estate, but also on the manufacturing side, we're seeing a lot of this companies moving a lot of operations back to the US, which is great for the country, but also helps them mitigate risk in their supply chains. So a lot of that is being moved back to America too. So vacancy rate, even as they're building more warehouses, more manufacturing facilities, as you see in the news, still the demand is voracious, and vacancy rate today is mid to low 4%, right? And historically, we've seen 7% and above. So this is a really tight environment, even with as much building as that's happened. So it's a good thing to see, although it doesn't affect us day to day.
Yeah, and a quick add-on to that, we're seeing a lot of what we call reshoring as well. This happened even before COVID, just with the cost of overseas manufacturing increasing. A lot of American firms have brought their manufacturing back to the States. And then with the whole COVID debacle with supply chains, a lot of folks realized, hey, even if we're paying marginally more for domestic manufacturing, at least we can control a lot more of the supply chain variables there. So both of those have been drivers pulling a lot of formerly overseas operations back to the domestic US.
And you talked a lot about the cash flow. It's really cash flowing well, but then how do you get to participate in the upside appreciation as well as an investor?
Yeah, absolutely. So our waterfall investments will take on an 8% preferred return. That cash flow is going to be right around there during most of the hold period. And it's going to stair step up. Each of the 20-year leases will have annual rent escalators between 2% and 3% a year as they increase, which directly flows into cash flow there. And then ultimately, as we sell properties, we'll return that investment capital, and then all profits after get split 70% to LP investors, and then 30% promote to our team. So overall, we're predicting approximately 16 to 17% IRR for LP investors.
And I'll add on to that. You see a lot of funds that are income funds, right? Sometimes debt funds. It's great for cash flow, but there's no upside appreciation. And then you see some value add. This is a great, hybrid income fund that has growth as well. So there's true equity ownership in all the properties that we've already acquired, as well as some of these properties that we will as we round out the fund towards the end of this year. So really a lot of appreciation you're able to participate in over time as rents continue to increase. And of course, we're paying down debt over time. So really some basic fundamentals. And of course, we're going to add value at some of these properties whenever there's that opportunity too. So investors get to participate in all that.
Right. I know we're getting closer on time here. So as always, Neil and Drew, thank you for coming and explaining. If any of you have questions, further question on how it works, do reach out to both of them. It's a great opportunity to be able to participate in the resurgence of American manufacturing, as we say here. So I want to wrap things up for the day as well by thanking all of our presenters from Warrior Centric Health, Open Atlas, finally Mag Capital. Everybody's got some amazing things they're working on the horizon, and of course, it's also very different. So I encourage all of you to see the opportunities that they have. I do want to close out too with an update. Last time that we were here, I call it the Commander-in-Chief Award. So it's which service branch has had the most opportunities to come and present the launch events. So I'll tell you that the Marine Corps is still in the lead. Coming up to pair, everybody added this month except the Navy side. So I'll have to talk to some peers here and figure that out. And we are still looking for the first Coast Guard deal to come through for the year. So if one of you is out there on the Coast Guard side, it could be you. So reach out and we'll see what we have on the next event. As I said, we are going to send a follow-up email. It will have the recording, all of the contact information, and different links that you can see from the presentations today. So I thank all of you for attending our event today, and from all of us here at Localvest, I hope you have a great Labor Day. Thanks.